Good afternoon, everyone. I want to thank you for joining me for the latest edition of Coffee Break. Today's subject I'm going to be discussing is tax loss selling. This is a little bit of a more technical topic than what I've been discussing the past few weeks, which have been more of financial planning fundamentals. But I thought it was important, given the current market opportunity, to discuss why we might be looking at tax loss selling at this point in the year, as opposed to at the end of every year when we would normally look at it. So to get started, just a quick word from our lawyers. Maybe I'll quickly explain what tax loss selling is before we get into the bulk of the presentation. So tax loss selling is a strategy that investors employ to reduce their tax bill. So if you own shares that have dropped in value since you bought them, so you have a capital loss, you can sell those shares and use that capital loss to offset any capital gains you have. And capital gains are incurred when you sell shares at a profit. So you must, when you have a capital loss, you must first apply that loss against any capital gains that you have in the same tax year. But if you have additional capital losses left over, you can actually carry them back up to 3 years or carry them forward indefinitely to offset capital gains in future years. So only losses that you incur in non-registered assets qualify. So if a stock that you own has dropped inside, let's say, your RSP or your TFSA, you can't use a tax loss. So this might not apply to you if you don't have assets in a non-registered environment. It's really just applicable for people who are paying taxes when they sell an investment outside of a registered vehicle. So we usually look at this tax loss selling strategy at the end of every year to see if there's anything that we don't necessarily want to keep in the portfolio anymore, if we've changed strategies, and if there's an opportunity to reduce your tax bill from any capital gains that we've already incurred for that year. However, I feel like this is a good time to talk about it now because we've had, obviously, a market correction due to the coronavirus, and a lot of the share values have come down. And I think it's a good opportunity to just examine portfolios, to reset, in certain cases, the investments that you own and rebalance back into the models that you have, or to potentially look at carrying those losses back to another tax year in which you may have had some capital gains that you've paid taxes on. So I'll go through those strategies in a bit more detail. But the first thing that I just wanted to cover was a little bit more of the basics on what are capital gains, what are capital losses, and how does this work. So I described a little bit of that at the top of this presentation, but I wanted to add some more details here. So when you sell an investment, you have something called a capital gain and you've made money on that. If you sold an investment at a loss, you have a capital loss. And currently, the current tax rules dictate that 50% of a capital gain is added to your taxable income in the year in which you have that gain. And the same is true of 50% of the capital loss. However, a capital loss can't be used to offset regular income. It can only be used to offset capital gains income. So in the year that they're realized, capital losses and gains will offset each other. So if you've got a gain of $20,000 and a loss of $5,000, you'll have a net capital gain of $15,000. However, if your capital losses exceed your capital gains in any particular tax year, you can either carry them back to the prior 3 tax years, or you can choose to carry them forward to any future tax years that you might have capital gains that you'll incur. So that's an interesting strategy that we like to look at, but the current market environment really provides that opportunity to take a look at perhaps doing that now. So I just wanted to give an example of what happens when you have capital gains and losses occurring in one tax year. In this particular example, we have a $50,000 capital gain. And if we don't trigger any capital losses, then our net capital gain is still $50,000. Only half of that's taxable, like I mentioned, so $25,000 is taxable. And at the top Ontario marginal tax rate of 53%, we pay about $13,000 in taxes, leaving you with about $37,000 net after tax. However, if you've got some capital losses that you're able to trigger in that same year, you can reduce the amount of taxes that you're going to pay in your capital gains. So in this example, if we have the same capital gain of $50,000 on one investment, but we have losses that we can trigger of $20,000, we can reduce our gain down to $30,000 and reduce our taxable gain down by half of that, because again, don't forget, we're only including 50% of your gain in your tax return. Therefore, you're only paying about $8,000 in taxes. So now you've saved a little over $5,000 in taxes owing by triggering that capital loss in that same tax year. That's if it incurs in the same tax year. But what I want to really look at in this particular presentation is whether you have a capital loss that exceeds any gains that you might take this year that you can utilize in potentially prior tax years or future tax years as well. So there's a couple different strategies that I think are important to consider. So one that we see often is that clients might carry positions with them from prior employers in which they've accrued a lot of company stock, let's say, and they become what's called over-concentrated in that one particular position. It might be a good opportunity now to look at the value of that stock and to determine if it's a good time to reduce your concentration in those positions, given that the net tax impact might be lower for you based on where the stock price sits now. And then the second strategy that I wanted to mention was to look at all of the holdings that you've got across your portfolio and maybe do an inventory to see that we're not duplicating any holdings, or get rid of some holdings that maybe don't fit with your or align with your investment strategy any longer. And perhaps those are at a loss now that you can utilize again to offset past or future capital gains that you might incur. This is actually a strategy that we're looking at, the second one, for all of our clients right now. So we're doing an inventory of all of the households to determine if there's anything that either doesn't fit with our forward investment strategy or that perhaps needs to be evaluated to see if we could either trim back some of the position or reduce the concentration if it's appropriate. So we're already looking into the second point for you. However, if you are not in a managed account with us, it's something that we'll have to discuss with you directly and determine if you want to do that or not. I'm going to just draw your attention to the first point and illustrate for you a sample situation in which this might occur. So this is actually one of our clients. He works for a large oil company, and he's accrued a lot of company shares. It's about, call it $1.5 million worth of shares. And in the past, he hasn't wanted to sell it because it represented a large capital gain. And there was no need for him to access the capital for anything. So there was no point for him in selling it, even though he had a lot of his net worth in that particular position. However, as you may or may not know, current market conditions have brought oil down pretty significantly to a point where he's actually at a capital loss with respect to his investments. And that's not great from a long-term investment perspective. However, it does give us a window of opportunity to look at reducing his concentration in that company's stock if that's something that he wants to do. Because now he's not going to have a large capital gain in that position. He's actually going to be at a loss. And if we take some of the shares at a loss today, perhaps if that continues to recover in the future, it will allow us to carry forward that capital loss into when he sells some future shares to offset some capital gains that he might have at this point, or sorry, at a future date. And we can also take some of the capital that we free up today and rebalance that into his portfolio where we can achieve greater diversification, which is really what we want to look at doing for any client portfolio as a solid fundamental financial planning strategy. So this may or may not be applicable to you, but it's one that's important to look at today just to say, does it make sense for me given my overall portfolio composition? So I think it's important, and again, this is something that we're doing in our client portfolios now, is really just to look at an opportunity to rebalance all of your capital back to your target asset allocation. This may involve, again, triggering some losses at the current state, but it will allow us to free up capital to perhaps make even better and more solid investments as we recover out of this market into what might be a newer and different looking economy. That's something that we're taking a look at again as we do our due diligence to the portfolios. It may also free up some investments that you might need for cash flow if you find yourself to be a little bit cash flow poor, or if you wanted to make other investments that you, let's say, weren't able to make because you didn't want to incur any sort of capital gain. That might not be a problem anymore, or you may have had that gain come down or even to a loss position that might allow you to access that capital a little more easily. So this is a good time to kind of re-examine everything, reset and look at rebalancing, look at investment opportunities, and really see if your portfolio and your whole investment strategy is still working soundly for you. And of course, we can help you with this discussion. The one thing that I will point out is to watch out for something called the superficial loss rules. So let's say, for instance, you have an investment that you own and it is at a loss, but you actually really like it and you really only want to sell it because you want to trigger that capital loss, but you plan on buying it back. Just remember, you cannot buy it back until 30 days have passed after you've sold it. That includes anyone who's at arm's length to you, your spouse, your children, anyone who's what's considered non-arm's length cannot purchase that same investment unless 30 days has passed. Also, the 30 days prior to that stock being sold, that applies to as well. So basically a 60-day window around that stock being sold before and after, you can't repurchase the same stock. Then CRA essentially deems that to be a false loss and they won't let you capture that capital loss. So just be careful of that if you are going to repurchase the same investment and just trigger it for capital loss purposes. So the next strategy that I'm going to talk about is, I put refile in quotes because it's not technically refiling an entire tax return, but it's looking at the strategy of how to take advantage of capital losses that you might incur today that you can look at reducing past taxes with. So say, for instance, you have a capital gain that you incurred in 2019 because it was a very strong stock market year. And this year you're looking at your portfolio and you're thinking, you know, it was a really strong year last year. I paid a lot of tax on that capital gain. How can I potentially reduce the taxes that I paid because I preemptively paid them, and if I had just left everything alone, maybe I wouldn't have paid them. So one strategy you can look at is to kind of reset your portfolio now, and then once you file your tax return for 2020, you can refile or submit what's called a Form T1A back for 2019 to offset the capital gains paid in that year. And that's called a request for loss carryback. And you can do that again for the 3 tax years prior to the tax year in which you sell that investment at a loss. And you can also carry that loss forward to future years if you don't have any past years to go back and refile to. So I'm just going to take you through a quick example of that. So in this example, we have a client who had an investment property that they just were not able to continue to rent out. So they wanted to sell it because it was no longer in a cash flow positive position for them. So they sold it, but they incurred losses of about $50,000. And that was, you know, something that they were not really able to, you know, do anything about. They took their losses and now they had that, but they didn't have any capital gains to offset it in 2019 from their investment portfolio. However, in 2018, they had realized some capital gains from their portfolio of about $45,000. And they paid taxes of about $10,000 on that gain. They were in the 43% marginal tax bracket. So one strategy that they can do is file a loss carryback form for their 2018 tax year for $45,000, which is equal to the capital gain that they paid in 2018. And hopefully they would receive a refund back from that tax year of about $10,000, which is equal to the taxes that they paid in that year. They'll still have $5,000 of capital losses that will be available to them to carry forward and use to future capital gains. But they've now recouped the taxes they paid in 2018, which they can also then use for either cash flow or future reinvestments. So again, this may not be applicable to you, but it might be something that you can consider if you have incurred any significant gains in the past 3 years. So that kind of takes us to the end of today's subject. Our next and last webinar in the series is going to cover some estate planning, and we're going to have a special guest speaker for this one. So we're going to ask that you send us your questions and anything that you want to make sure that we cover in that webinar. If you have specific questions around anything to do with wills and estate planning, domestic or cross-border, please do let us know. It's a great opportunity that we're having to bring in some important guest speakers to help us with this. So please send in your questions. And again, please reach out to Vicki or I if you do have any specific questions around tax loss selling for your portfolio, for your investments, and even for your external investments as well, because obviously you have a breadth of wealth and we might not manage all of it, and they all tie together in your overall financial plan. So it's important to talk about everything. With that, I want to thank you for your attention today. Hopefully this was helpful, and we'll talk to you soon.